Every trader searches for the perfect signal and indicator, an alert, a shortcut. But the elite traders, the ones who survive decades, they trust something very different. Not signals, not predictions. They trust time. And once you understand why, your entire trading worldview shifts forever. Most retail traders begin their journey believing that indicators hold the secret to consistent profits. Stochastic crossovers, immaculate divergences, RSI overbought levels each. One promises certainty, but after months of losses, a painful truth emerges. Signals lag, signals conflict, and signals fail when the market shifts regime. Professional traders discovered this long ago. What they trust isn't a flashing arrow on a chart. It's a dimension that governs every trend, every breakout, every collapse. Time. In trading, price tells you what is happening. Volume tells you who is behind it. But time tells you when something truly matters. From hedge funds to market makers, from prop firms to algorithmic desks, the most profitable traders see markets through a time-based lens. They watch cycles, sessions, volatility expansions, liquidity windows, and timing patterns that have silently shaped the markets for decades. This script uncovers why Timnot signals is the foundation of professional trading. Revelation. Markets move in time cycles, not signal cycles. Retail traders assume signals move the market. Professionals know signals only react to movement. They never predict it. What truly repeats is time. Markets move in rhythmic cycles caused by human behavior. Institutional schedules and global time zones considered T. Every major market opens and closes at predictable times. Liquidity rises and falls in predictable waves. There are times when institutions accumulate, times when they distribute, and times when they disappear entirely. These patterns repeat, day after day, year after year, regardless of which indicator traders use. Professionals study time-of-day behavior. They know that breakouts attempted during low liquidity hours fail more often. They know that trends born during the New York-London overlap tend to extend the longest. They know the first and last hours of major sessions hold the highest quality opportunities. Signals don't tell you this. Indicators don't whisper when the whales step in bad time doze. When traders finally shift away from blind signals and start studying timing patterns, they immediately notice their win rate changes, not because they found a magic formula, but because they stopped trading during the dead zones and began operating during the high probability windows. Professional traders don't chase signals. They wait for time to align, and that patience is one of their greatest edges. Every price movement is fueled by liquidity, and liquidity follows time-based routines. Institutions don't deploy billions randomly. They move in structured phases. Accumulation, manipulation, expansion, and distribution. Retail traders look at indicators that say buy here or sell here. Professionals look at time windows when liquidity is intentionally injected into the market. For example, liquidity hunts often occur minutes before high-impact news releases. Trend reversals frequently form at session opens or closes. Fake breakouts appear during low volume periods, especially Asia session. Volatility expansions almost always occur after long consolidations that meet time duration thresholds. Algorithms, especially at large investment banks. On time triggers, a liquidity algorithm might wait for a specific window like the first 30 minutes of New York before executing large orders. No indicator can anticipate that, but time can. This explains a phenomenon every trader has faced. Your signals are green. Your setup looks perfect, but the market reverses violently the moment you enter. That moment is often a timed liquidity sweep, engineered to trap impatient traders who rely on signals instead of timing behavior. Professionals avoid these traps because they know when the market is supposed to move and when it is supposed to be quiet. They align entries with these windows and stay out during dangerous times even if their indicators look tempting. Time becomes their filter. Time becomes their risk management. Time becomes their edge. A professional trader's chart may be simple. Clean price action, sessions, time levels. Meanwhile, a retail trader uses 10 indicators and loses because the retail trader reacts to signals, The professional reacts to time. The difference is night and day. Climax. Time determines market structure before it even forms. This is the point where everything changes. Every major move in the market trend reversal. Consolidation has a time-based signature before it visually appears on the chart. Consider how professional desks operate. They know that after a trend lasts a certain duration, probability of continuation drops significantly. They know that consolidations longer than a threshold often break with violence. They understand that markets cannot trend indefinitely without time-based correction windows. So while retail traders wait for indicators to cross, professionals are counting durations, measuring cycles, and tracking the internal clock of the market. This leads to a profound truth. Time predicts structure more reliably than signals predict price. Here's how this plays out. Before a trend ends, signals will still show trend strength, but time will show the cycle is exhausted. Before a breakout happens, indicators remain neutral. By the time of day or the duration of compression, signals a coming expansion. Before a reversal, indicators still follow price direction. But time tells you the move has overstayed its statistical lifespan. This is why professional traders don't need to be right about price. They only need to be aligned with time. And when a trader understands this, they gain the ability to anticipate reversals before they show, predict volatility before it explodes. Avoid setups that are too early or too late. Align their trades with institutional flow. Trade less, but win more. The climax revelation is simple, but powerful. The market is not moved by indicators, it is moved by time-bound liquidity cycles controlled by institutions. Signals react. Time leads. When professionals realized this, they stopped relying on signals altogether. If time is the true foundation of trading, everything retail traders believe must be The implications are massive and transformative. 1. Time filters out bad trades. Most losses come not from bad ideas, but bad timing. A perfect setup at the wrong time becomes a guaranteed loss. Professionals eliminate 70% of bad trades simply by filtering based on session timing, volatility windows, and duration cycles. 2. Time enhances risk management. If you know a liquidity sweep is likely in the next 10 minutes, you don't enter. If you know a major session closes in 5 minutes, you tighten stops. Time tells you when to size up and when to stand still. 3. Time improves market interpretation. Two identical candlestick patterns formed in different time windows have totally different meanings. A breakout in Asia. Session is weak. The same breakout during London, New York overlap can become a trend. Time contextualizes behavior. 4. Signals lose power without time. A retail trader may say, "My signals are perfect on backtests, but fail live." The reason is time. Backtests averaged across thousands of data points, but real markets operate in specific windows governed by human and algorithmic behavior. 5. Professional trading becomes simpler. Ironically, once traders adopt a time-based approach, their charts become cleaner. They remove indicators and focus on sessions, timing, windows, volatility cycles, candle, duration, liquidity, timing, market structure, protected by time. Trading becomes less mechanical and more intuitive, yet more logical. 6. Time gives consistency. Signals stop working during regime shifts. Time doesn't. Whether markets trend or range, volatility expands or collapses, institutions must operate within time-based constraints. That makes time a stable foundation. 7. The psychological edge. Knowing when not to trade gives traders immense confidence. Professionals spend most of their day waiting, not trading. Retail traders chase, signal hop, and overtrade because they misunderstand time's role. The implications are clear. Adopting a time-based lens doesn't just make you a better trader, it makes you a different kind of trader entirely. Here is the final truth that ties everything together. Professional traders trust time because markets are built on schedules, not signals. Exchanges open and close at fixed times. Liquidity providers operate in timed windows. News releases follow calendars. Institutions rebalance portfolios at quarter end. and month, even volatility cycles follow recurring time structures. The entire financial system operates on time, yet most retail traders ignore it completely. When you shift your focus from signals to time, you start seeing the markets the way professionals do. You stop asking, "What is the indicator saying?" You start asking, "What time is it? And what tends to happen now?" This change may seem simple, but it rewires your entire approach. You stop buying breakouts during dead hours. You stop panicking during timed sweeps. You anticipate trends hours before they appear. You know when to avoid trading entirely. You align yourself with institutional behavior without needing insider information. Trading becomes less about prediction and more about synchronization. You are no longer trying to outsmart the market, you are walking in step with its natural rhythm. The final reveal is this: time won't guarantee you profits, but ignoring time guarantees losses. Signals can't save you from liquidity traps. Indicators can't warn you about time-based market events. But time studied, measured, respected gives you the closest thing to a compass in the chaos. Professional traders aren't magicians. They're simply attuned to the market's internal clock. And now, so are you. By trusting time, not signals, you step into the world of true market understanding, a world where patience becomes power, timing becomes strategy, and the market begins to make sense in a way it never did before.